India has been eagerly waiting for a return to an aggressive capex cycle for a long time. Economists and financial market analysts alike have been stating that if the corporate sector deleverages its balance sheet, then the stage will be set for a resurgence of the capex cycle. Now, the corporate sector balance sheet has been reflecting a decline in the debt equity ratio, and therefore it looked like we are getting to a stage where capex cycle will begin. But what we're seeing right now is that while the leverage has gone up, has shot up quite sharply, investments into long-term projects by the corporate sector has not. So this is a situation, and it's interesting and important for us to understand what are the ramifications for this. So just a few details that as of September 2022, the net fixed assets of the corporate sector, of the listed corporate sector, increased by around 4%, which is single digit, low single digit. And this is what has been the case for the last couple of years or so. And if you adjust this for inflation, then the asset base of the corporate sector has essentially shrunk over the last few years. But at the same time, borrowings has increased. For example, as of September 2022, borrowings by the same set of companies increased by around 12%. A year ago, also, they increased by around 12%. So what does this mean? If assets are not growing, but borrowings are growing, then obviously the debt equity ratio is deteriorating, it is rising. And that's what we have seen. As of September 2022, the debt equity ratio of the listed companies has gone up to 0.64 times, which is the highest in the last 8 or 9 years. And it is much higher than the average, 10-year average, which is around 0.57. Now, as the borrowing has gone up, the debt equity ratio has gone up. One also sees that the cost of borrowing has gone up. So, while the corporate sector borrowed on an average at around 7.2% or so till about a year ago or so, that rate is now shot up to 8.6%. This is average, but it's a sharp increase from 7.2% to 8.6%. Now, you juxtapose this rising borrowing, falling, rising debt to equity ratio with one more problem, which is that the profit margins are falling. So the net profit margin of the corporate sector had increased to around 9.5%. Now it's down to 5.5%. So if you have rising borrowing, rising interest incidence, and falling profit margins, what's going to happen? The interest cover will fall down. And that has happened. The interest cover has indeed fallen down substantially in the period ended September 2022. That's when the creditors are going to start worrying about whom are they lending to, and they're anyway very cautious in lending for long-term investments in the fear of those investments getting into becoming non-performing assets. For the corporate sector, it's a Hobson's choice because their asset utilization ratio has shot up. It is very high right now. It is the highest in the last 10, 11 years or so. And it requires to increase the asset base now to continue to grow. But if it does borrow to increase the asset base, its balance sheet ratios become worse. And creditors are going to be cagey in lending to companies as well. But if they don't borrow and if they don't increase their asset base, then growth will not happen. So the choice is between stagnating or taking larger risks in an environment which is challenging at the moment. The global economic environment are not the best of times to invest aggressively into new capacities. But we have a challenge in front of us that the corporate sector may be forced to take large risks and invest. 2023 is therefore going to be a very discriminating year.